Hello everyone and welcome back. In this video we are going to talk about LandBridge because the company just reported earnings the fourth quarter of 25 and the stock was up massively. The stock was up like plus 14%. I have to check here profile, historical data. The stock went up massively because the report was quite good, plus 13-14%. And I'm recording this video just the weekend after this. We are back to prices we last saw in November, and maybe we will go to all-time highs in a couple of days if it continues like this. LandBridge is a stock that is very volatile. It goes up a lot, it goes down a lot. The sentiment is very weak. People celebrate too early when the stock is going up, and people cry like babies when the stock is going down. It's a speculative play, and very few people understand it. So in this video, I want to go through the report because I'm a shareholder and I'm obviously following what is happening. And I want to give you some elements from the earnings call that was pretty good actually. Okay, so I think we can start. In case it's your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And this is the first time I am buying LandBridge. I bought LandBridge a couple of months ago, in October 2024. And I also know TPL. That is a more famous company. I've been following this industry, royalties industry, for a while now. I bought TPL back in the days in 2020 and I sold at the absolute top. Since then the stock has gone down and now rebounding because they also reported good earnings, etc. There is a clear correlation. Let me start this video by saying this. There is a clear correlation between TPL and LandBridge. The stock prices follow each other. As you can see here, big brother TPL is going up almost to all-time highs. Look at this stock chart for TPL. Look at now this stock chart for LandBridge. You have the same phenomenon, a high plateau, then it goes down and now it rebounds. So obviously TPL helps LandBridge. Okay, first of all, I wanted to talk about the price action. Now about the report. The report was pretty good actually, pretty decent earnings report. Here, the company reported a revenue growth rate of 50%. They already announced a guidance for 2026 of $200 million in EBITDA. They declared increase in dividends and they announced for the first time a small buyback program. Okay, let me first start analyzing the reports, the fundamentals, the margin profile, and then we'll talk about capital allocation decisions. And then let me put a reminder here. We will go through a DCF model to have a good estimation of the fair value. Okay, so let me pull full screen so you can see well. Revenue is up massively, net income margin is down, but this is a seasonal business model, so it's okay. Free cash flow is up, operating cash flow margin sky high. We are talking about a royalties based business model. So for the full year 2025, revenue is up 80%. Now you should have a first question. Why is the company enjoying a growth rate of 80%? And why are they growing only by 50%? And what about the guidance? The guidance is a 20% growth rate. So maybe something is happening here. Okay, let me continue. Net income here, net margin of 30%. Adjusted EBITDA margin of 90%. Cash flow is up. Fair enough. Plenty of improvement. They have plenty of partnerships all over the world with plenty of US-based companies. They had massive acquisitions during 2025, etc. All the metrics are improving. More volume, better pricing, better royalties. You don't have a lot of things to say when it comes to this report for the fundamentals of the business, like the operations. everything is going up and to the right. And LandBridge had massive acquisitions in 2025, which is the reason revenue was up 80%. And now they are guiding for a growth rate of 20%, which means they don't expect any acquisitions. Why? Because of this paragraph. Because the balance sheet is highly leveraged at the moment. What do they have to say? Total liquidity was $200 million. We increased the debt level by $500 million at a 6% interest rate. The cash was this, blah, 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 blah. They don't explain the ratio. Okay, that's on the slides. They recently announced a buyback program of $50 million. So this is a mess. You should be looking perplexed at this report because a lot of things are happening at the same time. Some things are really good. Some things are really bad. And I've seen no one talk about this online. For example, why is a growth company issuing a dividend? First question. And now, why is a growth company doing a buyback? The company is not cheap. Don't do buybacks. Are you doing buybacks to offset your dilution, your SBC? Maybe. Are you doing buybacks because you want to please investors, certain kind of investors, like hedge funds? Maybe. As a shareholder, you should not like this. This whole paragraph of return on capital, dividends and buybacks. The market cap of LandBridge is what? $5 billion? So $50 million, that's 1% of the company. It's irrelevant, but still, directionally wise, a dividend is horrible. A buyback is horrible. LandBridge is very simple. They have lands in Texas. They acquire more lands in Texas to have a mega conglomerate of more lands in Texas. And they have partnerships partnerships with water companies, including their brother called WaterBridge, to operate the water segment business and the water cut to oil, water 1.4, etc. In the Permian Basin, you have a lot of oil, you have a lot of drilling, and you need 4 times more water, 4 times more barrel of water compared to barrel of oil. So the water business in the Permian Basin is huge, and you have to operate on their lands actually. You have TPL that does this, some private companies that are doing this, and LandBridge. So the business model is finished. You are a royalty company. People drill oil on your land. People operate water, desalination, all these kind of things on your land. And you just collect the royalties. No capex, no operation. The only thing you can do with your cash is use this cash to buy more lands, acquisitions of more lands. So the only capital allocation decision they have to make is not a dividend, not a buyback, more lands. You just acquire more lands, which they have done in 2025. But I don't like that now they are doing a dividend increase, dividend payment increase, and a buyback program. I think that's just speculative at this point. Anyway, look at the 2026 outlook. You have an adjusted EBITDA of $205 million to $225 million. As always, you have to reconcile this to see how much free cash flow can you generate. And you can actually look at the conversion rate they had. Meaning, in 2025, the company had adjusted EBITDA of $180 million. In 2025, they had a free cash flow of $120 million. I made some videos a couple of months ago explaining the free cash flow conversion rate, and I said I estimate the free cash flow to be 120, 125. I was exactly in the right spot. So what is great is now that we have this, you can calculate 122 divided by 177. You have a free cash flow conversion of 69%, let's say 70%. So you can kind of estimate what will be the free cash flow of the business for next year, for 2026, The guidance is, I can use the middle, I can use 210. So 210 times 0.7. And this is what you have, $147 million. What is the market cap of the company right now? Market cap is 1.74. So 5.74, sorry, divided by 47. This is your price to free cash flow for 2026, 39. The company is not cheap. Why are you doing buybacks? Why do I have shoe ads? I don't know. Well heard. Okay. Let me go back to the report. Here we go. I've talked about the fundamentals. I've talked about the capital allocation decisions. I've talked about the price to free cash flow 39. I've talked about the debt. I've talked about the stupidity of doing buybacks. And this is it. We will go through the slides and they will talk about the business in more details, like the operations. Download. How can I show you? Here. Oh, that's better. Let me put my face in small here. So you have slides and you have new slides, new KPIs that the management never shared before. For example, for the first time in slides, LandBridge is talking about surface use economic efficiency, SUEE. Okay? The revenue per acre, how efficient you are based on the lands you have. How much revenue can you generate per acre? Very simple. You want this to go up, this metric to go up. This is one of the most important metrics to monitor for LandBridge. And the management is giving you transparency. They say this, for the legacy acreage, revenue per acre in 2025 increased 14% compared to 2024 and 150% compared to 2022. So the old lands that you already had, not the recently acquired one, the old lands you had in the past have become more efficient. Also, for the lands that were acquired in 2024, you had a 145% increase from $200 of revenue per acre to $500. So for the more recent lands you recently acquired, you are getting more efficient. This is lovely. This is very good, a very green flag for this report. What do I have? Adjusted EBITDA guidance of this, representing 20% year-on-year growth. Management is clearly telling us we don't expect any acquisitions. We just expect to grow organically. They talk about their operations, what they do for people that are not following the story. If you want to if you are discovering LandBridge on this video, you can check my old videos with a better explanation of what the business does. The business is extremely simple. You have major risks, but major opportunities in the future. Revenue is going up as always. The share of revenue coming from oil and gas is tiny. Like 94% of the revenue is based on non-oil and gas revenue. Only 6% of the business is due to oil. So oil price fluctuations will not affect LandBridge at all. It's about volume and water. You look at all the metrics, everything points to the right direction. Adjusted EBITDA, all-time highs. Free cash flow margin, sky high. It's a royalty business. And metrics are trending nicely. This is their growth rate. This is their SUEE, if you want to know more about this one. I think their strategy of improving efficiency per land, per acre, is extremely promising. And the management team knows what they're doing, and it works. So you can compare this with TPL, for example. TPL has the same kind of efficiency, even to some extent better efficiency, more revenue per acre. But in 2022, this was the revenue per acre, $460 per acre. In 2023, $700. In 2024, 1,000. In 2025, $1,100 per acre. So they know what they're doing. They're doing more and more partnerships, more and more deals to have more customers, commercial drivers, and it is working nicely. Now, about their capital allocation decisions, something I'm not a fan of at all. First of all, they want to have a moderate debt structure. The target long-term net leverage ratio, they want it to be between 2 and 2.5. What is the ratio right now? I think we are above. Yes, here we go. You are at 2.8 right now. Okay? They are clearly telling us we have too much debt. This is also the reason they don't plan to make any acquisitions. To make acquisitions, you need debt. Now you have too much debt, so you literally can't make new acquisitions. Your long-term debt ratio, your target, is between 2 and 2.5, so they are over-leveraged. They know it. And instead of repaying the debt, what do? Dividends and buybacks. I hate it. Okay? But this is their first priority. Secondly, you have M&A. If you have nice land, they can acquire this land. 3, return capital to shareholders. I hate to see this. I just don't like it at all. I would rather they just completely stop the dividends and buybacks, but no investment is perfect, right? Okay, let me continue. They have too much debt. They want to repay their debt, but they don't repay their debt because of some things happening in the world. The corporate structure is a mess. This is a big red flag / opportunity for shareholders because nobody understands how it works out. You have 2 classes of shares, one with voting rights, one without voting rights. The holding company holds everything. You, me, as shareholders, we own nothing. We have no voting power. If the management wants to screw their investors over, they can do it perfectly legally, and we cannot do anything. Some private equity investments are manipulating the data. This is not good at all. And this slide, and only this slide, can prevent some people, can deter people from investing in LandBridge. This is a big risk. Governance is a big risk. You have LandBridge, you have also WaterBridge, you have also PowerBridge, 3 sister companies. You have the same CEO for 2 of them, WaterBridge and PowerBridge. WaterBridge and LandBridge, the same CEO. And you have a guy from Talent Energy for PowerBridge. They are all doing shenanigan accounting things together, and it is kind of working for the moment. So investing in LandBridge carries some risks, but also if they operate nicely, you are in front of the best royalty opportunity in this new digital age of AI. So that's it. That's a risky speculative play. It's high risk, high reward. The stock can go up 20% per year for 20 years, but also it can be a fraud. Now that you know this, do you want to go deeper? Apart from this, no, this is about water management. You have many risks. I mean, the seismic risk you have in Texas has to be considered. Apart from oil and water, LandBridge wants to be more welcoming towards data centers. They want to host data centers on their lands because now plenty of permits are rejected to build new data centers in Virginia, for example. And the Permian Basin is an ideal place to put your data center. You have cheap gas, almost free. You have an unpopulated area. You have people that will welcome you, like TPL or LandBridge. You have water, and you have, the big thing that is worrying for the data center is not in my backyard, okay? In Texas, you have nobody. So you have the space. You can do whatever you want. You can build whatever you want. And this is their pitch to welcome data centers. And for the moment, it is kind of working. They are doing some deals. Now about the transcript. A few things about the transcript. First of all, they talk about the SUEE, this new measure of efficiency. This is great, and I highly recommend you go deeper if you are a shareholder of LandBridge, because you have a question about this one, how they think about the efficiency, what is their target for the next 10 years. And I think their target in terms of efficiency is not, what is that? No, 10 years. They talk about the target they have for the past 10 years. 10 years. I don't know. SUEE. And what their objective is. Basically, they want to quadruple the efficiency of their lands for the coming decade, which is really bullish. They talk about their dividends. They talk about their buybacks. I don't like this at all. They talk about their new deals, and they talk about data centers. The TLDR is nothing. They continue to say, we are working on attracting data centers to be built on our lands, but so far, nothing. So there was a question from an analyst saying, do you have any color to add on this project of welcoming data centers? And the CEO said, the fact that the data centers are being rejected elsewhere is very bullish for the region. If you cannot build a data center in North Virginia, maybe you will build it here at home and we can welcome you. But apart from this, we have small deals here and there. The value proposition has never been stronger. We look forward to having deals. Nothing. Frankly, nothing. TPL has said the exact same thing. We have talks, but nothing for the moment. So this is a call option on data centers. I am not buying LandBridge for data centers. It's a plus in case it happens, but no. Okay, data centers, power plants. We will, in terms of approval, if you just look at the approval or the broader regulatory landscape, what we've really seen is the benefit of, Texas, call it more business-friendly regulatory environment. As it relates to data centers in 2025, by orders of magnitude, so more canceled data centers in other states than there has been ever in history. So people are seeing their data center projects rejected. There have been a number of articles that have come out on challenges faced in other states and proposed legislation to make future data centers that much more challenging because of this whole, not in my backyard dynamic around this impact of power consumption and water. Yeah, I mean, it. AI needs a lot of water and electricity. And when you have too much demand, you cannot handle everything. So West Texas is here, the Permian Basin is here, waiting for a call, okay? And they say at the end of the earnings report, but also during the report, that there will be an investor day in March, and they will talk about their new projects of data centers. What is this? Where is it? Independent. No. This is this one. The Investor Day of LandBridge will come March 19th, and the goal of this Investor Day is to pitch data centers. So revenue-driving industries, growth opportunities, the value proposition of LandBridge, data center deep dive, and Q&A. Maybe they will announce something, maybe not. I think we are still early. So now that you know this, now that you know that all the financials look fine, the business is growing a lot, but the business is decelerating in 2026 because of a lack of acquisition. They can't make any acquisitions because they are too leveraged right now. Now that you know about the stupidity of dividends and buybacks, now that you know about the increasing efficiency of their lands, do you like the report or not? For me, I like the report. It was pretty good, story as expected, and the business thesis has not changed. The stock price is moving a lot. And I started this video by showing you this stock chart. But the business model is not changing a lot. People freaked out back in November when a stock rallied to $85. And people cried when it went back to $40. Be ready. If you know it's a speculative play, just fasten your seatbelt and enjoy the ride. Because this is not the last time we will see this kind of volatility. Size your position accordingly. For me, it should be like 6% of my portfolio, something like this. So, I can lose it all. That's fine. And we will see. We will see. Okay, so if you go to the DCF model of stock unlock, by the way, if you want to use a stock unlock here for the best DCF model or Fiscal AI, you have discount codes in my description. You can use Fiscal AI completely for free for 2 weeks. Okay, and for stock unlock, you have a discount code in my description. If you think the free cash flow of the business will grow at 20% per year, which is reasonable actually, and if you think this is a business that deserves a price to free cash flow of 25, and now they have a free cash flow of 122, if this is your assumption, then the stock is overvalued by 15%. The fair value of the business is $62. And if you buy right now, you can expect a CAGR of 6% per year. So I think LandBridge is, for the moment, a little bit expensive. And I am not a buyer. With that said, I am not a seller either. Because if they announce something promising or a reacceleration or a new data center deal, the stock will skyrocket. And again, data centers are like a call option for me. I am buying LandBridge because of the business model, which is perfect for me, like zero capex, inflation hedge. You can grow 15-20% per year, very asset light. And I'm buying LandBridge for the longevity of the returns. So I'm okay if the stock stays at these prices for the whole year of 2026, and for 2027, it increases again. I'm okay as long as the free cash flow is growing 20% per year. In the long term, the stock price will follow the free cash flow. So the stock price will be 20% per year. And it's okay. A couple of months ago, we were at $40. It was a great buying opportunity, but nobody wanted to buy at $40. Now, I think it's pretty reasonable. $62 of fair value, it's pretty reasonable. If you think they deserve a price to free cash flow of 30, and if you think the free cash flow will grow at 25% per year, so that's a bullish scenario, right? Then, if these are your estimates, the business is 23% undervalued. The fair value of LandBridge is $91. And if you buy right now, you can expect a CAGR, a compound annual growth rate, of 14-15% per year. Okay, but that's very bullish, I would say. No, base case estimates should be 20% growth rate. Price of free cash flow of 25, that's fine. I'm not taking into account dividends or buybacks here. And yeah, a good fair value, $65. Now I am not a buyer at all. I'm not a seller at all also. I will just hold. You know what? I'm holding, and LandBridge for me is a long-term hold actually. I have been following the industry for a while, the royalties industry, and LandBridge has one of the best business models I've seen. So I will not sell because it's 15% overvalued at all. So I'm just holding and letting it run. What if it goes above 100? So be it. What if it goes below 50? So be it. The same way I have handled the volatility in 2025, I will do the same in 2026. All in all, it was a good report, I think. I liked it. It was not perfect, and we have more visibility for 2026. No acquisitions, you just grow roughly 20% per year, and data centers will be a call option just in case you have a deal, just in case you have a new project. So I will continue to monitor and hold LandBridge for the moment, and I see you tomorrow for another video. Bye bye. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn my strategy to generate 25% annual returns. You will learn how to find winning opportunities. You will learn how to properly value any stock, when to buy, when to sell, so that you can build a strong portfolio filled with great companies. Additionally, inside this coaching program, you will have access to an exclusive community of like-minded investors, and also you will have my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need for your email address, just click the link in the description and I'll see you on the other side.